Hi, this is the second section that describes the calculations that are done on the IRR page. So the page that's dedicated for enterprise valuation analysis and ultimate derivation of internal rate of return, which is in this case 99.4. In the previous sections, we described several elements that go into this page, and here we're going to go through a little more specifics as well as show on the spreadsheet where certain things are calculated. Let's jump right in, and we're just going to scroll down this page. Now, remember, the main policy for the model is to have supporting schedules, supporting calculations done on the separate tabs that are kept away from the main client-facing exhibits. So it has to be a separate tab, except for in this case, those supporting calculations are left on the same tab as the client-facing area, which is this. This goes to the client. Client will see that. They typically won't see what's below. We'll keep it this way. It's a little bit against the policy, but just a convenience. And net working capital calculation is an important part, and it's described in a separate training. We're going to go to depreciation and amortization. So as you remember, and let's jump back for a second. As you remember here, depreciation and amortization are introduced here in the model to adjust the cash flows to get to the free cash flow number. Those numbers could be provided by the management if the forecast for balance sheet and free cash flow forecast is provided by management. Then we do use their numbers for depreciation and capital expenditures. In case where the forecast is not provided, then we have to do the forecasting ourselves. And so the first place to start would be to forecast capital expenditures in this line. These capital expenditures are typically forecasted based on one key assumption, which is the percent of revenue that the company spends on capital investments. And in this particular model, the information was actually provided by the client, and therefore we're not we can track it. But really, the capital expenditures are calculated simply by multiplying your revenues by a certain percentage, let's say 5% of. And that's how we come up with these negative cash flows that reduce your net income because you have to make those capital expenditures. Now, once we come up with capital expenditures forecast, we need to come up with depreciation. Again, in this model, depreciation is provided by the client. As you can see, we'll click quickly here. This is what came from the client. But if you scroll down on this page, there's this area that helps you calculate depreciation. The depreciation consists of two elements. One is the depreciation that comes from the pre-existing fixed assets on the balance sheet, and those are net property, plant, and equipment. It's not a gross amount. So in this case, 200 was the opening balance of property, plant, and equipment. We make an assumption that it takes 3 years. 3 years here, it's a driver cell, and this is a driver cell. 3 years it takes to depreciate the opening balance. So you'll see that the opening balance here starts with 200 and then it drops over the course of 3 years. This is where the actual depreciation happens. So you'll see it takes 3 years to get rid of that 200 balance on it. We start with 200, but then the company keeps making investments in capital equipment, and so those investments are these numbers. These are the numbers which are essentially the revenue. Here's the revenue multiplied by CapEx assumption. So you will see how revenue multiplied by this capital expenditure assumption, this 21% is really high. But those are the capital expenditures each year, and those capital expenditures, because we select this 4-year depreciation, those numbers, for example, this 393 gets depreciated over a 4-year period of time. The next year's investment gets depreciated over a 4-year period of time, and it's based on this number, 3794. So this waterfall of depreciation is consolidated down here, and so this is the total depreciation. So each one of those depreciation totals take into account the depreciation that comes from opening balance sheet here, as well as subsequent investment in capital expenditures. And this is how depreciation is calculated, and then this depreciation would be linked back into this line. You'll see it's different here because, again, these numbers were provided by the client, but that's the part that's being calculated down here, total depreciation, and we're just going to highlight that real quick. So that's one. We're gonna stop here just for the sake of not making those recordings too long, and in the next section we're gonna talk about we're gonna talk about tax amortization benefit.